What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Happy Friday out there. Hope you guys had a good week. Let's end it up here with tons of big news. Big macro day today. Market sell-off, bond yields crashing, and Bitcoin kind of holding in there. So we're going to go through a bunch of stuff. I did write a bunch this weekend, and let's just look at that stuff real quick. Or sorry, this week. And if I can find my right tab here. Bitcoin and markets.com. That's the homepage. All my stuff comes out here. Writing a ton. I used to be writing for Bitcoin Magazine Pro. Now I'm writing just for my stuff, pumping, cranking out the content. Please, guys, like and share my stuff around on Twitter, on your socials. I don't go on Facebook. If you guys frequent Facebook, share my free stuff around there. But let's take a look at some of the stuff came out in the last couple of days. So I think we talked about that one last time. 1970s versus today. This one came out yesterday. I see this chart all over the place, and that is comparing the 1970s inflation with the inflation that we are seeing right now, quote unquote inflation, right? This is CPI. And this particular example right here is actually pretty good because they do show two different axes for the inflation, so you can tell that there's something fishy going on, as well as giving the years down here. So this is one of the better ones that I have seen. But what I went ahead and did was took the exact CPI from that time and put it over here to today. And I lined it up pretty much with the same years that is commonly used. I've seen a 1966 through 83. And so that's what I took here, 1966 period, starting where this red is and pulling it over here with comparing it here. And you can see that this started from a higher level. It started at 2% and just went up from there. We started at 0, basically, and went up from there. But it's kind of misleading to look at these two eras. First of all, we are at the beginning of the big Eurodollar expansion back here, okay? And now we're at the end. So here you could have high inflation and high growth. Lots of credit creation, lots of growth. Here you can't anymore. We're saturated with debt. The globe is saturated with debt. The US is saturated with debt. And you have diminishing marginal returns on debt. So you get low growth and actually low credit creation. So this was always going to be transitory. Now the shape similarity, the reason why the shapes are similar is because it's a year-over-year measure. Okay, that it takes about 12 months for it to get baked in all the way, and then 12 months for it to come out once it hits the brick wall, because the economy can't handle this 9.1%. This is this shape is just an artifact of the way that the number is produced. Okay, and for a clearer look on that, I did a month-over-month chart here, and you can see back here in the 70s there was a sustained era of higher month-over-month CPI. It never dipped down below to 0 or down to this below 0.17 month-over-month, which is what you need to hit. If you had 0.17 month-over-month every month, you would be at 2%. It's actually like 0.168 or something like that, but 0.17. And you can see they barely had any that dipped down into that zone back here in the 70s. But if you go out here to if you go to today, we had this little spike, and then it went down back to normal, back to post-GFC normal, which is what I was calling it all along. Post-GFC normal, you can see it dips down below 0. It spends a ton of time below this 0.17 month-over-month, and that's exactly what we're seeing. It didn't have a era like it did back in the 70s of sustained higher month-over-month. So all along this was going to be transitory, and I said it, and so this chart is misleading, and Hope that gives you guys some ammo if you are ever debating somebody about that. Okay, let's go to the next post that I made, podcast replay. This was this morning, Bitcoin Minute, RFK versus Trump versus Kamala on Bitcoin. You guys might have seen this infographic floating around showing how Kennedy is so great on all this stuff and Trump is not so great, but better than Kamala Harris. But what I wanted to point out was that I think this is giving too much credit to Kennedy. I also think that empty spaces on Trump are not the same as empty spaces on Kamala. So, like, for example, this one, support running a Bitcoin, support running Bitcoin nodes at home. Trump's is blank. He hasn't really talked about that, but he hasn't said he won't do that. But Kamala Harris, we know, will not do that. So he's open to that. So that was how I approached this, and I remade the infographic, or just added a little bit to it to make it more of reality here. So this is how I revised it. So the orange is open to the possibility, and green has directly voiced support, or it logically follows from their argument. So I added in a couple green ones here for Trump, and also all of these orange ones. So he's open to this. He's never said that he wouldn't be willing to do this. He won't be shutting down the Fed like Kennedy has talked about. And he probably won't be using a Bitcoiner as a Treasury Secretary. So those are the two that I did leave open. But of course, Harris has none. So anyway, that's a more realistic comparison. What else did I write about this? Excuse me. Let's see. And guys, these are all free. So sign up for the free tier on the website and you'll get these in your inbox. And I also tweet them out. I'm also going on Instagram as well. It's Bitcoin_and_markets. And I'm on True Social. And so I try to get them out as wide as I can. But okay, so what I say regarding for the purchase of 4 million Bitcoins, this claim is missing the point. While Trump hasn't explicitly ruled it out, he has stated his intention to form a strategic Bitcoin stockpile. So this purchase 4 million Bitcoins, that misses the point. On the tax-related points, Trump has an intimate understanding of the tax code and has consistently advocated for lowering taxes. I mean, he is as familiar with the tax code as RFK is with the CDC and the FDA. All right, so that's like one of his specialties is the tax code, and he's consistently been lowering taxes. We have the Trump tax cuts, for instance. So again, while he hasn't directly addressed these issues, he's certainly open to the idea, unlike Kamala Harris. Okay, supporting the Treasury Secretary from the Bitcoin community is, in my opinion, odd. That's just an odd point because it's like, oh, we need a DEI hire for Bitcoiners in the Treasury. No, you want to have the most qualified person there. And most likely it's not going to be a Bitcoiner. So that just seems odd as a point to have on the infographic at all. Julian Assange is already free. There is some remaining investigations and legal pursuits, and those will be most likely dropped anyway. So that takes that tick off away from Kennedy. Pardoning Edward Snowden, while it's something that should happen, I'm unsure whether Trump would do it, but it is possible. RFK's platform includes other policies that could contradict his Bitcoin stance or harm the economy overall. For instance, he supports strict environmental regulations that could conflict with Bitcoin mining. Yes, he says he's a fan of Bitcoin mining, but if he's going with these strict environmental regulations, it's going to take some deconfliction with Bitcoin mining, and that could lead to a conflict. He also advocates for increased government spending through universal child care coverage. Additionally, his proposal to raise the minimum wage will hurt low-income families by forcing companies to lay off workers. So anyway, then I showed you my corrected one. So that was that post. And then, August price forecast competition. Can't forget this one. Okay, guys, so if you are not paid members on the website, get over there. $5 a month, you can join. And every month we have this competition. The person closest to the price at the end of the month wins $20 in sats. This month's winner was DT, so congratulations, DT. And I've updated the Hall of Fame. So if we go here, let's open this in a different link or a different tab. So we have Hall of Fame, all of our profits with how many times they've won. And you see you can get your name on the list here, going back all the way to 2019 when we were on Discord. But yeah, it's a fun community thing to do, and you can win $20 in sats. So get your entries in, join for $5 a month, and you can join us as well. All right, and lastly, let's take a look at some of the macro stuff that happened just today. So this is the premium post that I put out to the professional tier. And if we scroll down past the Bitcoin stuff, I want to get to the macro stuff. Oh, I linked to this episode when I was on Mark Moss last year because in here, I predict pretty much exactly what we're seeing right now, that we'd have a good first half of the year. And as we enter into the third quarter, things are going to start to really deteriorate. So go check that interview out. Spot on. Okay, so this morning we had a horrible jobs report, and you can see in this little table, unemployment rate came in at 4.3%. It was forecast to be 4.1, remaining flat, but that did not happen. Big miss on that. Non-farm payrolls missed by 65,000 jobs. So that was a pretty big deal as well. And this triggered the SOM rule. Now, I've talked about this before in other posts. It occurs when a 3-month moving average of the unemployment rate rises 50 basis points above its low. This is a real-time indicator, implying we are in a recession right now. But remember, a recession is 2 quarters of negative GDP growth plus a couple other indicators like unemployment and stuff like that. So if we are in a recession right now, it won't even become an official recession until the end of Q1 next year. Or sorry, would that be correct? No, it would be if we end Q3 negative and Q4, then that's when it would be called an official recession. So we're still a long way from anybody saying that we're in an official recession, but the SOM rule is telling us that it has started. You can see every time that it hits this mark, we are at the beginning of recession, or even within the recession a little bit. And we would be actually within this recession because these dark lines usually cover at least 2 quarters. 2020 was an exception. It was only 2 months actually, but yeah, interesting. So we are likely in a recession right now. Also, the ISM manufacturing PMI came out this week, and it was a horrible 46.8. Estimated it was supposed to be 48.8. The unemployment component was shockingly bad. So if we look at this, green is employment. This was huge, negative, shockingly bad down here. This is the worst decline during the recent contraction, normalized to 0 depth of stacked components. So what I said was the stacking here is normalized to 0, and it's at negative 3.2, or sorry, this dotted line. Is that right? Yeah, negative 3.2. So that's not the lowest this cycle, but the stacking, the actual month over month change, that is the worst that we've had in this entire cycle, the month over month change. I worded that badly, and I was confused when I wrote that. Remember that no change month over month would be 50. So this 0 here would be 50, like over here. And that means that the purchasing managers report things are getting worse every month. If you're below 50 consistently, it's not getting like, I don't know how to describe this. It's not like 48 moving down to 46. No, every month is moving down from 50. So every month moves down more from 50. God, how do I describe that? It's accelerating to the downside. And just look how many months this has been negative. This is contraction in the PMI, in the manufacturing PMI. This is really bad news. This is recessionary. This also says we are currently in a recession, just like the SOM rule does. Okay, continuing down. My favorite real world indicator is the US 10-year. We can take a look at that. We can also take a look at the 2-year, because that sold off really bad today. But you can see here, we are testing the structural support from back here, fell out of this channel badly, but we are very, very oversold. We're actually the most oversold going back all the way to COVID. So I do think we could be in for a bounce here, because there's nothing like COVID happening right now. So this is most likely we're going to see a significant bounce on this structural support from back here. Now, will it go, back up to 4.5%? Probably not. It's probably going to bounce and then take a little time and then continue to fall in the next month or so, over the next month. And then if you stack them all up here, these are just selected ones: 3-month, 1-year, 2-year, and 10-year. 3-month actually dipped out of this range, and the 1-year and 2-year and 10-year are diving. What do I say about that? I say all of them are crashing right now. This is a rapid move that I don't think will continue much longer without a significant bounce. This is panic driven by fear the Fed will wait too long to cut, Japan raising rates again, and the JPY strengthening, and all the bad economic data this week. I think the panic is overdone. Just look at that move. I mean, you have to go back here to March of 2023 during the banking crisis to see a similar just collapse like this. That is a crisis. That is a panic. That's what we're seeing right here. So I don't think this move is going to continue much longer. We're going to have a reflective bounce. All right. That then is all of my writing. Let me check with the comment section, see if there's any comments so far. BTCP says, it feels like RFK was throwing unrealistic Hail Marys. Yes. Yeah. Promising everything under the sun. Yeah. His campaign, remember, just go back in time like a year. Everybody was much more bullish on RFK. He has some good stuff. Like, I was going over his platform today, and there are a lot of good things in there that I do like, but he is such a climate guy. And the universal child care, while that's going to get probably a lot of votes, it's probably going to be pretty popular. That's not something that I would ever think about voting for. It's just like universal health care is forcing somebody else to pay for something. It's also supporting something I think is detrimental to demographics. Now, I'm not saying that it's wrong, but I'm saying it's detrimental to the long-term viability of a country, of a economy, to promote childcare like that. So, you should promote one parent staying home, being able to stay home. That's what you should actually be funding. You just think, okay, so what's the cost of universal childcare going to be per kid? It's probably going to be thousands of dollars a month, right? Why not just give that to every parent? If that would be more promoting good family, good demographics. You give that check directly to the parents so the mother doesn't have to work. But if you subsidize childcare, you're actually undermining the family. You're undermining certain values that you need for demographics. And so I just think that it's a horrible policy. Dangerous policy. Also, the minimum wage is a dangerous policy. So he has a few things that are good. He has, I would say 75% of his platform is good, But the ones that are bad are dangerously bad. Climate regulation, universal child care, and also raising the minimum wage. Those things are dangerous. So, anyways, any other comments? Nope. Let's check Telegram. We were talking about, let's go to a live chart. We were talking about Ethereum earlier. And it's had some bad days. This is Ethereum versus Bitcoin. And it has come back down to these lows. If you go to the USD, it's set a new low since the ETF launch. Let's measure this now. So we'll just go from the top of that candle down. So it has fallen 15%, over 15% since the ETF launch. And if we go to the Ethereum flows, they've only been positive for 3 out of the 7 days. What is it? 3 out of the 8 days. 1, 2, 3, 4, 5, 6, 7, 8. And the ones that were positive were not that positive. 33 million and 26 million. Almost $500 million negative outflows. Bitcoin never had a negative total. This is disastrous for Ethereum. And so that could be weighing down as well on the price of Bitcoin, because as I explained the other day, there are algos out there, algorithmic trading bots that will trade the spread. And if the spread between Bitcoin and Ethereum starts getting out of hand, they will, try to close that spread, sell Bitcoin, buy Ethereum. And that could be weighing Bitcoin down. Okay, what else can we look at here? Let's take a look at the 10-year, because it is just a sight to behold, man. Down to 3.79 now. Jeez, that is not good. Where's my channel? It can't be this far down. This one. Where the heck is it? There. What's it doing way down there? So this is the channel we were watching for a long time. You guys saw it on that other chart, and man, it is just crashing. Did it get below this? No, it's touching right on this right now. So we'll see where that goes. But also, if you take a look at the RSI, it's way down here, 21 on the RSI. That's incredibly oversold. Most oversold since COVID. Let's check the 2-year. I have to go to my other list here. 2-year down 6% on the day. 6.5% on the day. Wow. This is incredibly oversold. This is down daily RSI at 12, people. Daily RSI of 12. That's going to rocket back the other way. Did it even get that low in COVID? Let's see. Yeah, I got that low in COVID. But not long before that. I mean, you have to go back over 10 years to see something this oversold on the 2-year. So, yeah, this is going to bounce. And it's going to catch a lot of people off sides. A lot of people right now are buying bonds. They're buying TLT. They're buying, the bond ETFs. And they're going to get stuck the wrong way. And this is going to squeeze them back the other way. This is going to bounce pretty hard. Again, 12 on the RSI for the 2-year. Wow, that is incredibly oversold. Okay, let's go back to some of these other ones. If you guys are watching on Twitter, jump over to the YouTube and Rumble. Like, comment, subscribe. If you're watching on YouTube, Rumble, like, comment, subscribe. Even if you're watching this later, put a comment down below. I usually come back and check all those comments. All right. Let me make this bigger. So What else should we take a look at? We took a look at that. Let's take a look at the dollar. Sold off today. But I mean, this is not that bad, all things considering. It's still within this range that we've been watching now for quite a while. I expect this range to continue. So I did call a dollar wrecking ball and then to enter a range. And that's pretty much exactly what's happened. It's a little bit lower than I expected, but it is ranging right now. This move is really coming from the JPY. Look at that move. This was intervention. So they did some intervention. Let me get my arrow out. They did some intervention here. Okay. Didn't do much. And then they did some intervention here. And then they just raised rates again. So they raised rates, did a bunch of intervention to strengthen the yen, collapsing the carry trade, or pushing on that carry trade for it to become uneconomic and people having to get out of that. And that's one thing that's going to be affecting our stock market. It's going to be affecting the dollar. It's going to be affecting our bond rates, so our treasury rates. So all that could be driven off of this. And again, a panic move. Let's see what this RSI is. So this RSI is not too low. We could see this continue to go. Remember, as it drops, it's getting stronger, and as it rises, it's getting weaker. But look, there's not very many periods where it does get to be open. And this is on the weekly time. If we go to the daily, it's going to be very oversold on a daily. Okay, so yeah, this move could stop here on the daily. But going back to the weekly, it doesn't like to get oversold very much until we go back all the way to the GFC. Then we start getting some oversold conditions. Okay, how about oil? I haven't been checking this. Let's go to the daily. Take the RSI off. Computer's running slow here. Okay, down day on oil, testing the lows from early June. Not surprised. Again, I can see this getting down into the 60s very easily, and in recession, getting down into the 50s. We are in a period of oil glut. People don't want to admit that, okay? People don't want to admit that we are in an oil glut, but we are. We are in an oil glut. And we can go back and forth on this forever, but Luke Gromen and what does he call it? Peak cheap oil. That's absolutely ridiculous. I mean, $74 oil right now. If Luke Gromen were correct, we would be pushing above 100. We'd be pushing above 150. But it's just not the case. We are in an oil glut right now. Demand around the world for oil is crashing for several reasons. One is the rise of these Chinese EVs and EVs in general has had a marginal impact. I don't think that's going to continue, but even if we go hybrid, like I think hybrid is a very, very good solution to this whole thing. And if you go hybrid, you're going to be getting double the gas mileage in many cases, and so your demand for oil is going down. But guess what else is happening? The population is falling. The Japanese population is falling by 1 million people a year. That's coming everywhere, guys. Population is going to start going down as efficiency is going up. The demand for oil is going to peak out. That's why I call it peak oil demand. All right. S&P 500. This was a nasty day for the S&P 500. Look at that big gap down. All right. So that's all I got for those live charts. Let me check and see if there's any other comments. If not, I'm going to sign off for the weekend. It is raining, so I don't know if the food trucks are going to be there today. Okay. BTCP asks, is this a big bond short squeeze or just a reaction to the non-farm payrolls data? This is not a reaction to non-farm payrolls. Non-farm payrolls is baked in the cake. I mean, it's for one, it's July data. It's already happened. Just like CPI, it's already happened. So it's not due to that. It's been happening for several days. If we go back to the chart and we go to the 10-year, we see this top here occurred on July 24th. So this waterfall cascade has been happening a long time. This is a squeeze. It is a short squeeze. And people were way on the wrong side of this. That's a good point. This has just got liquidated down here, pushed everything way down here, but we're going to have a pretty significant bounce because of this oversold. Another thing, the PMIs, people were talking about, it could be a reaction to the PMIs. PMIs are actually concerning to me. They're so low. Nothing I expected. This is one part of my thesis that I'm going to have to relook at because it did not come out the way I thought. Now, my thesis has the U.S. outperforming everybody, which they are by a lot, double Western European GDP. The U.S. has since COVID. So, and China, that's, they're basically in recession. And so the U.S. has outperformed. However, I expected there to be a lot more manufacturing activity in the United States. There's a lot of investment in activity. So like investment in manufacturing, new factories, new chip fabs, new things like that. And so it's coming. It's going to take a while to build those out, to get the proper labor into the United States, because all of that chip manufacturing labor is over there in Taiwan or South Korea. So we need to get that back over here, build up the labor force here, along with the factories. That could take, it's been how long since COVID and this trend has been going? So I would say it's been going strong for 3 years, but it might take another 3 until we really start seeing the PMI exploding higher. Until then, it's probably going to be a pretty hard recession. Some of the things are looking a lot like the Great Financial Crisis. I don't think it's necessarily going to be like the Great Financial Crisis, though, because that was bank-centered. I think the Fed has learned enough tricks with their emergency lending facilities and all of that stuff. I think they've learned enough tricks to bail themselves out of a 2008 type event. We'll see. If a systemically important bank implodes, then that's a different thing. But right now, it just kind of looks like we're going into a recession because demand is falling off a cliff. The economy is just slowing down. That's different than a banking crisis where the economy can explode or implode because money stops moving. That's what we faced in the Great Financial Crisis, and why, they say that we were hours from the entire global economy blowing up because it was a banking crisis. This is not a banking crisis. This is an actual crisis of economic activity. And so, and it's largely, you could trace it back to slowing of China. The US or the global economy really relied a lot on the Chinese growth. So China grew enough to keep the world afloat, and there is no growth there anymore. And what do we see? Every other economy is starting to crumble under its own pressure, under its own weight. The weight of $35 trillion in debt. And not just that, but private debt. The world is saturated with debt, and our boat is starting to take on water. Different than a Great Financial Crisis. So, anyway. That's that. Let's check Telegram, see if they made any comments in here. No, nothing else. All right, guys. Well, that's where I'm going to leave it then for today. So thanks for joining me. Get outside, touch grass, spend time with friends and family. Hope you have a good weekend, and I'll see you on the next one. Bye.